Hello everybody, my name is Lush Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record a video per week, so make sure you ring the notification bell to get notified each time one comes out. Let's talk about how macro events affect the stock market, where macro means big worldwide events that affect the whole market and economy, rather than micro events, which are things that affect only individual stocks. A solid example of macro events is interest rates, wars, and how they affect your stocks. So let's look at interest rates first. Interest rates are set by central banks, and in Canada, and especially in the US, watching the US Federal Reserve's changing of the short term variable rates, and particularly the commentary by the central bankers, seems to be a national pastime, analyzing and interpreting every single word in the statements and the press conferences. Lowering interest rates does the following things. It improves and speeds up the economy. It makes money cheaper, so companies invest in infrastructure and people spend more, improving revenue for other companies. Everyone borrows to buy, whether individuals or companies, so interest affects demand. Borrowing is cheaper, so lower interest rates go straight to most companies' bottom lines, but especially for indebted companies like utilities and real estate investment trusts or REITs, which bought everything using debt. Banks are harmed by lower spreads between the deposit interest and the loan interest rates. As interest rates go down, banks pay lower interest on savings and charge less on loans, but the gap between them is shrinking as rates go down. Now, this time around, we have an exception for the banks. So, from midway 2022 through to today, we have had an inverted yield curve on both sides of the border. This means yields on short-term bonds are higher than longer-term bonds, which is even worse for banks since they theoretically pay more for savings accounts than they get from loans. In this situation, lower interest rates will bring the shorter-term bond yields down, actually helping the banks. Insurance companies, which invest your insurance premiums in safe bond vehicles, get lower returns, so insurance companies are harmed by lower interest rates. With higher interest rates, the opposite happens. The economy slows as people's and companies' spending and cost of borrowing becomes more expensive. And in a normal situation, the banks get bigger spreads between what they pay on savings and charge on loans, thereby benefiting. And insurance companies make more on the bonds that they invest your premiums into. Now, bonds, speaking of which, are affected by interest rates as well. As interest rates go down, new bonds pay lower interest rates, and so the existing bonds are made more valuable as they are still paying higher rates. Bonds can have capital gains in a lowering interest rate environment. When rates are being increased, as in 2022, existing bonds become worth less, being discounted to make up for the lower interest rate that they pay, so they take a hit. The other macro events I wanted to take a look at are general uncertainty and wars. Markets hate uncertainty, leading to selling and a lack of investment in places of uncertainty. Markets prefer solid, known bad news better than unknowns, letting the markets use their imagination. Oil goes up on uncertainty, however, since the supply might be at risk. Wholesale sell-offs on macro events are a great time to buy when people panic and sell companies that have nothing to do with whatever is happening. Wars, of course, are the definition of uncertainty because we don't know what's going to happen, but we do know that it's going to be violent. Wars cost money and improve the economy. World War II got the world out of the Great Depression, and rebuilding also employs people on both sides and improves profits for companies. When a war begins, there's usually a quick sell-off across everything, but within a few weeks or at most months, the markets recover and people realize that the war is not going to affect profits of most companies. The war could also just cause more volatility in the markets with big moves day to day, but no consistent direction up or down. Of course, companies that supply weapons, logistics, supplies for the war will benefit, obviously. If the war involves a country that supplies commodities like oil, wheat, etc., or the country can affect the trade of those commodities, the price of the commodity will go up and could stay up as long as the threat remains. In general, macro events, including interest rate moves by central banks, need to be evaluated, and panic selling or greed buying needs to be avoided. Wait to see whether the interest rate change or the war actually affects the company's bottom line profits, rather than guessing at the news effects on the fundamentals of the company. If you have any requests on what you'd like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.